Today, we're going to break down what happens when you give a group of university students 100,000 ringgits in virtual cash and tell them to play the real stock market. We're going to look at their strategies, their discipline, and maybe most importantly, the psychological battle that every single investor has to fight with themselves. So, just picture this for a second. 100,000 ringgit. It just appears in your trading account. Now, you can't go out and spend it, but it's very real virtual capital, and your job is to trade it on the actual stock market. And here's the kicker. You've only got 2 months. That's it. So, what's your first move? How do you even begin to think about making that number grow? Well, this is the exact challenge a group of students had to face. All right, so let's set the stage here. This wasn't just some simple classroom exercise. It was basically a crash course in real-world finance, with all the pressure that comes with it. So here are the ground rules. The players, a team of students from University Science Islam Malaysia. Their mission, should they choose to accept it, was to invest that virtual 100 grand. The playground was the Bursa Malaysia Stock Exchange, and the timeline was tight, just about 2 months. The goal? Simple to say, but really hard to do. Get the best possible return using professional-level strategies. Now, you and I both know that you can't just dive into the market and hope for the best. That's just gambling. So before a single ringgit was spent, these students built a proper strategic blueprint. Let's dig into their game plan. Their whole approach was built on the 2 major philosophies of investing. On one side, you've got fundamental analysis. This is like being a detective. It asks, what should I buy? You're digging into a company's finances, its health, its earnings, trying to figure out what it's really worth. Then you have technical analysis. This is more like being a market psychologist. It asks, when should I buy? Here, you're looking at charts, patterns, and crowd behavior to time your entry and exit just right. The students decided, wisely, to use both. And they didn't just wing it. They built this very methodical 5-step plan. This was all about discipline. It started with the basics, research. Then, setting super clear goals for how much they were willing to risk and what their profit targets were. Now, step 3 is the one I find fascinating. Mental preparation. They literally trained themselves to fight against their own emotions, fear and greed. Only after all that did they actually prepare the trades. And finally, they committed to analyzing everything, the wins and, just as importantly, the losses. A huge part of their risk management was something called a cut-loss strategy. Think of it as a financial safety net. Before you even buy a stock, you decide on the exact price point where you'll sell if it goes against you. And if it hits that number, you're out. No hesitation, no second thoughts. And the thinking behind it is just so simple but so powerful. It's all about making sure that small, manageable losses don't turn into catastrophic ones. You're choosing discipline over wishful thinking. And believe me, this wasn't just theory for them. They really put it into practice. Take Axiata Group, for example. They bought in, but when the stock dropped about 6%, boom, they executed the plan and sold. Same thing with ECA Integrated Solution. A 10% dip triggered the sale. You have to understand how much emotional control that takes. Your gut is screaming, just wait, it'll come back, but the plan says sell. And they followed the plan. Okay, so we've seen the plan, we've seen the rules. Now let's see how it all held up when things got real. It's time to step into the arena. So their first big case study was a company we all know, Nestle Malaysia, a pretty safe defensive kind of stock. But the question is, how did they know when to get in? This is where their technical analysis came in. See this chart? Those blue and red lines are called moving averages. They just smooth out the day-to-day price noise to show you the underlying trend. And look at how the price, the little candles, is consistently staying above those lines. That's a classic sign of a healthy upward trend. They saw this little dip right here, but instead of freaking out, they saw it as a perfect buying opportunity because the stock bounced back so fast, it just confirmed how strong it was. So their analysis was spot on. They saw the strong trend, they used that dip as their entry point, and their conclusion was solid. And the result? They made 2 different trades on Nestle and came out with a combined profit of 230 ringgit. That's a clean, disciplined win right there. Okay, so was that just a lucky break? Let's see if the strategy worked with a completely different kind of company, Press Metal Aluminum. And you know what? The chart tells a very similar story. The price is just cruising above that blue line, which is a key moving average. You can think of that line as a rising floor for the stock price. It's providing dynamic support. Seeing that clear bullish structure gave them the green light to jump in because they were confident that the upward momentum had legs.
So, after 2 months of all this, of staring at charts, of managing risk, of fighting their own gut feelings, what was the final score? It's time for the debrief, the wins, the losses, and the real lessons learned.
So what did the final numbers look like? In total, they made 21 trades. Out of those, 13 made money, 7 lost money, and 1 was a wash. That's a win rate of over 60%, which, let me tell you, is a fantastic result for any trader, student, or pro.
But it was definitely a roller coaster. Their single biggest win was 180 ringgit from PBB Group, and their biggest loss, a 202 ringgit hit from ECA Integrated Solution. Yeah, that's the same stock we saw them use their cut-loss strategy on, which just goes to show how important that rule was. Without it, that loss could have been way, way worse. So, when all the dust settled, what was the bottom line? A net profit of 375 ringgit. Now, look, they didn't become millionaires, but that was never really the point. They started with 100,000 and they ended with more. They protected their capital and they made it grow. Mission accomplished. But the most valuable profit they made wasn't in ringgit. This quote from their final report says it all. We had to counter the instinctive feeling of holding on to losing trades in the hope of recovering. I mean, that one sentence perfectly describes the core psychological war that every single investor fights every single day. And that really brings us to the real takeaways here. This whole thing was a masterclass in the psychology of the market. It taught them discipline, to actually stick to your plan when every fiber of your being is telling you not to. It taught them patience, to wait for the right pitch instead of swinging at everything. It taught them acceptance, that losing is just part of the game, you can't avoid it. And most of all, it taught them about continuous learning, about how you have to study your wins and your failures to get better. Which really just leaves us with one final thought. As this whole experiment showed so clearly, when it comes to investing, what's really the tougher thing to manage, your money or your emotions?